Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
Well, there's certainly a lot in between at the moment. The in-betweeners. Maybe we can call this podcast that because there's a lot of soul-searching at the moment for a lot of people. It's the new adolescence for property investors. They're going to be coming of age in a very different age. Potentially, who knows? Maybe nothing's different. That's where I'm going to start today. It's above my pay grade. Paul Glossop, Pure Property Investment. This is your podcast. We're here to talk about property. Do you still like property?
Well, mate, the more things change, the more they stay the same, Philip. That's the saying goes. Mate, I don't see anything different.
No.
And I'm look, we're doing trips down memory lane every other day, it feels like, and the things that I was actually listening to a podcast with one Alan Kohler yesterday.
Oh, you listen to other people's podcasts?
I do,
Trader,
not yours. Nothing
Trader.
to do with you.
Who was it?
Alan Kohler.
Oh, yeah.
Alan Kohler. Stalwart. Anyone who's probably listened to it.
He's become really quite popular.
Well, it's funny that it's one of the things that he was a guest on a podcast.
Yeah.
And they sort of he's been in the finance media space for over 50 years. I was like, my God.
Reckon we're going to be there.
Old.
Reckon we're going to be sitting there one day going, I remember back in 2026.
Well, it's funny because he spoke a fair bit, and anyone who's been listening to or watching ABC News or reading any kind of financial articles for the last few decades or probably 50 years, ultimately, as it's turned out, they would have heard or read of his stuff. And he's actually a very wise guy, and he actually stays very current. The more I listen to him, I was like, wow, he's not a dinosaur talking about back in the day stuff. He's talking about different periods of time. Where I'm going with that is that they asked him a question, but like, how do you stay current and how do you stay focused? He's like, well, it's kind of funny because he said in the last 5 to 8 years, he said specifically because he's in his 70s, he said, I've actually become a lot less patient because the stuff I was writing about, talking about, pontificating about in the 70s and 80s and 90s, I was a lot more reserved. I was probably the quintessential ABC journalist then.
Yeah.
Where you play a straight bat down the line, don't ruffle too many feathers, because they realise that what he talked about, the strategies, the different things that need to change for things to change, just nothing really ever stuck. So he's kind of said, well, I'm older, I'm less patient, and I'm more happy to tell it how it is now.
Yeah.
And that was a big part of it because he actually spoke about the fact that he wrote about need for changes to taxation and a range of other things. Now, it's not that I agree with his mindset or methodology or even strategies on how to make housing more affordable, because that's what the podcast was revolving around. But it was interesting because it was like he does recite a fair few things that are quite interesting. But the long story short of where his message was is that, look, we've had tax changes, but we haven't had anything to address supply. And the other edge to the equation, he said, well, look, the home affairs side of things haven't necessarily addressed anything to do with immigration either. And if we're not building more property and we're still letting circa 300,000 people migrate to this country permanently per year, we will have a deficit. And a deficit effectively means that we don't have surplus property. So we are going to go through softening of markets, but we're not going to go through corrections of 30 or 40, 50% for 10 years. So until that's addressed, nothing will change.
We've been speaking at length around the supply side of things. I've seen snippets of that podcast, and the snippets I've seen, and he's a pretty reasonable economist, and he sort of looks and smells and thinks like an economist, but he's quite pragmatic as well. He said that he didn't believe property investment constituted a good investment.
I heard
in
that.
The future.
Yeah, and I thought that's an interesting take. But he's been bearish on property.
Yeah.
Pretty much infinitely.
Yeah.
And there's no shortage of people similar to him, fortunately or unfortunately, who have been towing the same line for a long time. I can think of Shane Oliver, who's probably another one, who's probably relatively similar lines to that, who's been pretty bearish on property for about 3 decades that I've been paying attention to what he said. And he's aligned to ANZ, has been for a very long period of time. And they make money off lending money. But
I think philosophically they probably more lean towards property being somewhere where
Shelter.
someone lives rather than an investment vehicle.
And that's fine. So, I mean, it doesn't change the fact that that's not what we believe as well. But until someone can prove that it's not a way to park money and leverage and make money out of it safely and securely, then I'm not looking for another avenue.
Yeah, and it's all being unraveled at the moment. You pick up anything, you watch TV or jump on newspaper or whatever, you see this ongoing debate around what it means for the housing market. And the Treasurer and the Housing Minister is sort of, they're defending the position. Everyone's saying, well, property's going down. And they're saying, well, property does go down. It's a property cycle. So everyone just take it easy a bit and, it might go down. And, they point to Treasury modelling being it's like the Wizard of Oz, right? This Treasury modelling, it's this sort of big all-important thing sitting at the end of the yellow brick road that makes all the decisions that is really just a couple of blokes probably sitting there pulling some levers behind a curtain that don't really know what they're doing. It's a bit sort of extreme view, but Treasury modelling indicates that property will just grow slower than what it has been growing. And everyone's pointing out the fact that is negative growth actually slowing growth? And this whole discussion is going to continue. But, whether or not you believe property's going to go up or down is probably going to influence your decision making. It's good to see Alan Kohler there chatting about those things and chatting about supply. And we should talk about this at the top end of the podcast. I don't want this to be a podcast on it because there's a lot out there. But one of the more significant second and third order effects of removing the ability to borrow inside of your super fund for the purposes of buying residential property is the fact that about 30% of all new build, 30+% of all new build apartments, so developers, when they put a development out of the ground and they need to get money for it and they've got to pre-sell, 30% of that is typically people buying them inside of their super fund. You've completely taken that demand out. But what's the impact of that? Well, supply is going to be more restrictive because it's going to be harder and even more challenging now for developers to develop. If you take that market out of it, is that going to be replaced by first-home buyers that are happy to and investors maybe who are buying new build because you can't buy established anymore? Is that going to replace what you're taking out as a result of the super funds? And I can't see that happening quickly.
No. Well, I mean, the data suggests that super funds, resi super fund lending makes up circa 1% of all lending. So, I mean,
it's 1% of the market,
1%.
But 30% of all off-the-plan purchases were to people who are buying inside of their super fund.
This is the hypocrisy, right?
Yeah.
Like they've let the Greens go and dictate terms to say, great, you support us, we want this, great. We're not even going to ask questions or say, what about new builds? Because this is all about trying to create more supply. Yeah. A pragmatist would have said, well, let's maybe just leave SMSF lending open to new builds if we actually care about supply. But for
they could have allowed that.
They could have easily just said, "Hey,
and you probably would have got
you
more
would have got people on
buying.
side. You would have been people saying, "Great, that makes sense." I mean, how hard would that have been?
Just
how hard would it have been?
Out of the super.
It's just bonkers. Like it's just literally that in their office they must just literally have the word property investors, the words property investors, and just have like literally a cloak and daggers scenario saying this is all we care about.
Yeah,
because ultimately their agenda has zero real substance behind it other than the fact that we just want to make sure that they can't get ahead or they can't better their lives without essentially our involvement.
My whole view of this is, and I'm sort of already a bit fatigued with it all, is, okay, government, Mr. Government, the government, you only get one chance to take all this away. Then you're exposed.
Yeah.
So if you take it all one go, yes, evil property investors, we've fixed the housing market because we've fixed the big problem, which was property investors. Okay, we've fixed them now. We've hobbled them. We've tied them up. We've put all these rules and structures to govern how we want them to react and respond. That's done. Okay, we've done that now. We've stopped the evil property investors. You only do that once, right? Then now they're exposed, going, okay, well, if you don't actually,
if that doesn't work.
if you don't get the outcome that you want, and no one's really too sure what the outcome is. I think the outcome they want is that they want more young people in property, so they want more first-home buyers in the market. Right? So
that's the tagline.
So that's because housing is more affordable. Everyone's going, well, does it actually mean it's less? You take everyone's wealth away from them. So you've done all that. Okay, let's see what you can do now. Let's actually see if you get the result that you want.
Well, I mean, this is where nothing, and I can't see how I can't see how anyone who's not associated with Labor are going to let this one pass. And I'll be frustrated and disappointed with anyone at the next election if they don't come up with a policy to actually address supply. Because, I mean, no one needs to kowtow to property investors because essentially that's not going to win them votes. No. What's going to win people votes is here's how we address supply. And what hasn't been addressed is that exact question: is how are you actually addressing supply? Nothing
in the budget. And then we were telegraphing. I remember chatting with you pre-budget, going, I reckon I'm going to have a crack at SMSFs.
Yeah,
saying they're going to remove SMSF borrowing,
and they didn't want to touch that because they knew that
there's no way they want to put it. It's too much in the election, but they knew they already had a deal in the back.
Oh, absolutely. The Greens already tabled saying, yeah, we're going to do this, and they did it in the back rooms. Yeah. They did it away from the public eye, and then they essentially just announced it because they said, here's what it's going to be. We're going to present it here, and we're going to make.
I reckon
the Greens the bad people.
Yeah. I reckon they went. I reckon it was in the draft budget papers, and someone said, no, we don't need to put it in there.
Let's use the Greens
because we'll go to the Greens going, we're going to need you to do this. Hey, we'll give you this if you do this. So
we'll
they took out the budget papers.
Okay with it.
Happy.
Yeah.
I mean, being cynical, obviously, none of this happened. None of this sort of stuff happens.
None of it happens. But here's my point: is that you
to be fair, the coalition considered the same thing around borrowing inside of super.
Yeah, they did, yeah. and. There's so many laws around buying in super. Yeah. I mean, you and I are investors in our super, and it's not simple, and it's time consuming. It's expensive. You need certain liquidity tests. You need certain incomes. You need certain contributions. There are rules around it. It's not the Wild West.
Yeah.
It is and will remain for commercial investment a difficult way to buy property intentionally because they don't want people to be frivolous and speculate. Ironically, this is the same government who allowed everyone to access their super 4 or 5 years ago quickly to just go and buy crypto or use it to go and pay off their HEX debt or buy a new car for a period of time. This all still happened with people's super as well. So they let people do whatever they wanted with their super for a period of time to try and inject cash in the economy. Anyway, we'll go away from that for a second. But going back to supply, if they expect, and when I say they, the government, whether it's Labor, whether it's someone else, if they expect supply to come to the market, which is the only way that property prices are going to stabilize for a long period of time, is that if you inject heaps of supply for a prolonged period of time, either private developers have to bring it to market or the government has to deliver it themselves.
Yeah.
And the only way that this will happen and the only way that the market will go flat or sideways for a long period of time is if the government pays for it. And I explain the reason this is that the government can do it and say, we've got a 30-year horizon to make our money back on this housing.
Yeah.
A private developer has 3 years.
Yeah, they need the monies now.
And a private developer is never going to go and put huge amounts of money on the line for a 3-year outcome in a market that's in decline when there is less people buying property. So that hasn't changed. They haven't incentivized them. They haven't changed taxation rules around that. So unless, and this is potentially a theory of mine, that unless they all of a sudden go and say, you know what, we can throw some massive incentives to these huge super funds.
That's what they're doing.
That's what's going to be.
That's what's happening. That's what's happening, right? They're going. What was it? It's about $3 trillion in super.
About that, yeah.
I think $1 trillion in self-managed and about $2 trillion in union industry funds, right? So I think they're going to do that by proxy. So the government don't want to be landlords because they're not very good at it.
No.
And to get constant,
and
they're broke, and they can't take too much more from the Australian people to fix their spending. So and it is dangerous for the government to be landlords, I think, in this day and age because of the political cycle. You need continuity, and there's so many rorts. And I'll raise it also. I don't know if you saw coming through this week was changes to Commonwealth procurement regulation laws, and this got chucked into some other bill that was going through, right, which pretty much said that the Commonwealth will, and I'm going to it's quite technical, but if I get this wrong, can someone please tell me? But essentially, the government will prefer to contract for large-scale government tenders to companies that have good enterprise bargaining arrangements. So essentially, they're unionised companies that have a unionised connection to it. So the government's saying we're going to contract on a basis that you've got these enterprise bargaining agreements, which obviously the union's saying we want these blokes to be getting more work, right? So it's all interconnected. It'll be sort of like it's not really conspiracy theory stuff, but the government by proxy will preference these type of companies, but the government by proxy don't want to be landlords, but they'll be proxy landlords by incentivising the big funds to own residential property investment because they've stopped other people, self-managed super fund people, from doing it. So they can do it. So because they're managing your money, we'll let them invest in residential real estate and they'll start just building massive blocks. And I reckon that's what developers now, they're just going, we'll develop and we'll sell it to some sort of fund and then they'll manage it. So this is pretty common in Europe, right? You just get big funds, big sovereign funds or whatever funds own real estate. They build to rent. And that's not a thing here in Australia. But what's going to happen is that's going to shift. So the big funds will be the owners of large-scale residential investments for the purposes of renting them out to Australians, and that's where a lot of Australians will live. And you're already seeing a lot of the rules that govern the way in which this happens has already been put in place around tenant legislation right across the different states. So that's what it looks like. So you can't do it in your self-managed super. So if you're managing your own money as your own fund, you can't do that. But the big funds, which are union-backed, which is essentially politically government aligned to the current government, they're going to be able to do it, and they get much better tax breaks as a result of it. And you're also getting a lot of foreign investments in there as well. So you're going to get, Australian funds teaming up with Japanese funds, and they'll be buying stuff together, and they'll just be assets. Like, that's future.
And it goes back to,
which is good for supply, but it means the inherent. You might be strengthening the supply equation because you've got a purchaser at a price of the things that you build, and it's going to be providing rental stock because they're built to rent. I don't fundamentally mind that. But if you're doing that, you should make the same thing available to people inside of your super fund as well. It's exactly the same concept.
Well, the rules just aren't the same.
No.
And this is the unfortunate part. And it goes back to, ultimately correct me if I'm wrong, but essentially the Keating era where we had the mandatory super contributions, where all of a sudden now people don't have a choice. So if you're not setting up an SMSF and investing yourself, then your money's going into an industry super fund typically, and that industry super fund is then therefore going to be funneling money into what historically is also very, very basic returns. Like these are unleveraged returns, and it goes back to what we've talked about so many times is that SMSF property in resi only makes sense with leverage. We never talk about, and you can actually still buy, for anyone's listening, the rules basically state that if you want to buy residential property in your SMSF, you can still do it. Any time in the future, you have to pay cash. So that's the way that they want it to be.
And there's already a whole bunch of schemes. And I've been on the social media talking about this, going, look out for the new version of the property spruiker.
And there may be some good ways for people to come up with creative ways to say, here's how we can fund it. I don't know those ways yet, and I think the technicalities will probably, and there'll probably be loopholes that'll be closed quickly if they do open up. But let's assume that that'll come and maybe go quickly. But their intention is to say, look, you can buy property, but we don't want you having any leverage. And we've spoken about it at nauseum that leverage is it is the eighth wonder of the world in SMSF in particular, because you only need a 5% average annual return to get circa 15 to 20% technical cash on cash return for your deposit.
And that's essentially tax free when you're in pension phase, right? If you sell the property. So it made a lot of sense, and that's sort of been cut off. So anyway, there's a lot of consequences and ramifications around it, but
can still do it in commercial though. So word to the wise. So if anyone's interested in that in commercial, absolutely reach out to us.
We're recording this just after the financial year, and I've got commercial property. I was looking at one of them yesterday when I was getting all the statements for end of financial year, and I looked at it and went, I wish I had more of them.
Yeah, it's doing all right.
It's
punishing to set up. It's a punishing process. But
but you don't want too much of it, right? Because the taxes come in now over $3 million.
Yeah.
So that if you if your share of your self-managed super fund or even outside of super is more than $3 million, you're going to get taxed.
Net.
Yeah.
So you're ways off being net.
Yeah. So
Maybe
if you've got $3 million,
with your fancy portfolio, fancy
someone's
SMSF,
got to do it. But,
someone's got to do it.
So this is all complicated. So what does it all mean for property investors? I don't know.
Well, I think SMSF property investors don't get too discouraged because there are ways forward, and that might be commercial. So that's
you got to get a whole bunch. But commercials are different, mate. The amount of commercial transactions in Australia annually is tiny.
It's low. It's very low.
There's not that much good stock. There's a lot of commercial property out there
and it's certainly not for everyone.
No.
And commercial property in SMSF in particular is not for everyone. But we're more than happy to talk to people about understanding where they're at and what they have, because there are certain people who it's for, and we've certainly got resources behind that space to accommodate for it. But I don't want that to be where people are thinking straight away, well, I was going to do resi, but I'll do commercial. We'll have a chat about it. Most people it won't make sense, but there are some that it will. But let's park that, because I think for me that's...
And back to the super very quickly, and I want to sort of learn a bit more about this. It's a relatively new sort of concept I've been sort of drawing my attention to. It is, from what I understand, what a lot of people do is they reach a retirement phase and they've got this big sort of tax-free chunk of dough, right?
Yep.
The number is like 20 or 30%. I can't remember exactly the number. But a lot of people retire with still a substantial amount of debt on their principal place of residence.
Yep.
So what happens a lot of the time is that people just go, they've got this big super fund, they reach pension phase, they pull it out largely tax-free. They pay off their principal place of residence with it, right? So they take all their super money, a lot of their super monies, pay off their principal place of residence.
Which
so they have
also tax-free.
Which tax-free, so they have no more debt on their principal place of residence. But they've eroded the size of their super balance, so they still need the government pension.
But they qualify for the pension.
They qualify for the pension.
They drop their actual super
their balance, because all the money's over here.
Because the principal place of residence
so
is
you
not
remove the debt
tested.
over here.
You can have a $50 million home and it's not means tested.
So a lot of people are saying is that the SMSF system is broken because it's not actually changing how much the government needs to pay for people in pension phase, because people are just shifting dough straight from the super fund and their principal place of residence tax free. That becomes part of your estate, and then that means it can be channeled around and moved around. So it's not necessarily working as well as what they thought.
There's going to be, and this is the thing where people will constantly, the government will constantly think we've got a great idea, we've got a great scheme. There's going to be ways around it, and there's never going to be a perfect fix to it. And ultimately, if you have a $10 million home that you had $1 million debt on and you retired and you're like, I've got $1 million, I'm just going to pay it off, and you don't have an income, you technically are in a problem. You have a problem.
You need money.
Your ultimatum is you sell the house and you downsize and use that money for something else, or you qualify for the pension and you go and get your minimum pension. And if that's enough to satisfy your life,
that's good. But the point being, though, is that if you hit pension phase, you pay off your principal place of residence. That means you get the pensions. Then you've got your assets. Yeah. Then you downsize.
Yep.
There's some smart stuff you can do. You speak to an accountant.
Anyway, absolutely.
Outside. Now we're going to do a shout out. I'm going to start doing shout outs.
Oh, shout outs.
Shout outs.
Okay.
So there's a guy.
This could be any number.
And I spoke to him. And I'm not going to say his name, but he's listening.
All right. Can we use initials?
No.
Oh.
He knows, but I'm gonna. He's got to know that we're talking about him, because it's a guy we both know.
Okay.
And he's a hardworking tradie who's been dreaming of retirement. I think he always thought he'd be retired at 50. His kids are all grown up or left.
He
the
should
house
be
largely.
retired.
He's worked his guts out. He still works 7 days a week.
That's a long lineage of
working their guts out. Still working like ridiculous hours, and he's still his dream is still. He's already got his Land Cruiser and
caravan,
and he's talking about caravan, and he loves to fish. I know right this second. I know he is fishing. He's on his yearly trip. And I'm not going to say exactly where he's fishing, but I'm going to say
mid to far north coast.
Mid to far north coast of New South Wales, and he's got a secret fishing spot,
which I've never fished out of. You have, I think.
I've fished at it.
But I do believe I've fished out of a separate secret fishing spot off the rocks, more locally to Sydney.
And I spoke to him during the week. He loves the podcast. He spends, and there's something in this. He sits there with his pliers in his hands, stripping cables, plugging them in things. He does a lot of works like on secure data centers and stuff. It's a good sparky in that. And all day, just headphones in, listen
All
to the
day,
podcast.
all night.
He's probably the
Pure
most
property.
informed person in property.
I don't
If
doubt
I've got a question, I call him and go, mate, what's going on? What's happening? So it's shout out for,
Right.
for all the tradies out there who, rather than listening on their, Makita boombox, Triple M or Kiss FM,
Between
whatever,
Triple M and
mate,
the Pure Property
put
podcast.
podcasts on the work site for all the young chippies and plumbers and stuff
Get
out
in the
there
head.
who aren't buying, stop buying jet skis and Ford Ranger utes and get them investing in property. So this is the call out to all the tradies. Podcasts on building sites. You've got
Switch them.
You've got so much time to educate yourself all day, every day on what's going on.
Oh.
And I tell you, your toolbox talks will be a lot different for, what'd you do on the weekend to, thinking about doing this, that, and the other,
Yeah, no, mate. I live in the Sutherland Shire of Sydney, which is a melting pot of tradies,
Yeah.
and it's very successful ones out there as well. And I tell you, it never ceases to amaze me how many young tradies, in particular, I speak to who are in a position to get themselves started and have dodged the traps of I'm just going to do whatever their normal pilgrimage would be of get a massive debt on a very expensive car, work for 10 years and piss it up the wall, for lack of a better term, which is kind of a bit of probably a previous stereotype of a tradie. But I tell you, there's a lot of bloody well-educated and well-prepared tradies.
And they could be doing a lot better than what they do, because a lot of them still, they're not always so good. I'm generalising. I like tradies and a lot of tradies. They're not always great with cash flow management.
No.
So a new thing. There's a new thing.
Okay.
Toolbox Talks with Glossop.
Okay.
On Friday afternoons.
It's just quick, short and sharp.
No, Toolbox Talks with Glossop on a Friday arvo. You dial in. What's your email address?
We'll go inquiry at purepropertyinvestment.com. Give us some topics.
So if you're out there and you're going, I like the sound of this, I really, we've got a good building site, we've got some young blokes there and people trying to make their way. Paul will come out.
Oh, right.
With his barbecue and a slab of EB on Friday afternoons.
grill.
He'll come out Friday lunchtimes and he'll do toolbox talks with Glossop around property. And you can ask him any question around any question.
Ask me anything. Maybe
Ask me anything.
like a 10-minute smoko, or maybe even lunch
No,
break.
it's
We'll
gotta
do
be
half an hour,
lunch
45
break,
minute
lunch break.
Get the bangers going before, half an hour before. All right. It's got to be a minimum quorum of 5 people.
Yeah, I was going to say 10.
10. Let's go between 5 and 10 at a minimum.
Yep.
And I don't want anyone thinking, this is boring, I'm going to go to 7-Eleven instead. It has to be there.
Toolbox Talks with
Not
Glossop.
there, then B square.
If you're tuning into this, mate, I would jump over that.
Okay.
All
right, done deal.
He'll come there.
Yeah. I don't want any fancy like tier 1 development sites where I have to go through and put a hard hat on and a high vis vest.
No.
I want good
No
old
safety
fashioned-
checks.
No, I don't. I'll wear enclosed shoes.
He'll do his,
Don't get me
he's done
wrong.
his site induction. I've got my white card. I'm allowed on site.
I am too. I'm on.
Oh, you got a white
many,
card?
Yeah, I'm
Yeah.
on many a building site.
Yeah,
Yeah, I've got a few developments.
You got a white
myself.
card?
I don't have a white card. Sorry.
Joker.
Or maybe can I get on site without a white card?
You can do. You just can't do anything.
Okay, that's pretty normal anyway.
Mate, I don't think Glossop knows. I don't
Why
know.
do you need a white card if that's the case? What do you do on a building site?
I'm very proficient.
At what? At talking.
Well, yeah. Mate, I challenge
You're the
anyone.
hype man.
Mate, put me on a building.
This is it. If I'm going to be there, you need to be there in the background.
I'll
Just
come.
a hype man. Just
I'll come. Yeah. I'll be sitting there cooking the sausages. 2 minutes Turkish. Mate,
I like it.
I reckon
We'll record a
this is the
podcast on
thing.
there.
I
like
reckon
it.
this is the thing. Toolbox
We'll
Talks
do
with
the
Glossop.
rounds. All right.
And we'll come out on a Friday arvo. We'll
book
bring
them
the
in
bangers.
monthly.
Monthly. Yep.
Toolbox Talks.
Toolbox Talks.
We'll go national.
Yep.
We'll go national.
Yep.
As long as it's somewhere within an hour-ish.
It's a mission. I want this. I reckon, mate, trade is the backbone of this nation. Right? We don't have enough of them.
We
right?
definitely don't have enough.
And the ones that we capture to actually choose that as a profession, it's such a great way to manufacture long-term wealth if you do the right things at the right time.
Agreed.
So Toolbox Talks.
All right. Send me an email, inquiry at Pure Property Investment, saying I'm interested in getting a toolbox talk with Phil and Paul on our site. Tell us where the site is. Tell us who's going to be the audience. And we'll come along. I reckon we set up the podcast.
We can do that. We do
can
everything.
Set it up. We can mic it up. We can record it. Doesn't have to be fancy.
Every single small to medium. It's probably about small to medium builders, right? You've got an obligation to look after your crew and pay them well and do all that sort of stuff, mate.
It's professional development.
It is
probably
professional.
A good way, actually.
It's great professional development.
Because it's going to be bloody impossible to get professional development on bloody building sites.
No, I love being on building site.
Flipping some snags, and maybe we'll do some chicken.
Yeah.
Maybe something a little bit kosher as well. Halal. We'll get a few halal options
halal.
if need be.
Mate, we've got a lot of our Lebanese friends are builders.
A lot of our Muslim brethren.
Yes. That mate, they're prolific investors.
Absolutely.
Property
Plenty
investors.
of them on our books.
Yeah.
Yep.
So we'll go anywhere. We're going to start in Sydney.
All right.
We'll see how popular this is, but I don't know. Maybe we're stuffed ourselves. This is going to be.
It could be interesting. I'll wait to see. Inquiry at purepropertyinvestment.com. Make sure you mention where, when, and what the site is, and that way we can maybe even give you a little shout out on the podcast as well. Have a look at your quality of your work.
Yeah.
Look at your freight.
Yeah.
And make some decisions accordingly. But more importantly, give everyone a bit more of a heads up into ways that they can diversify their income.
For a lot of people, it's inaccessible. It's inaccessible, insights and it's more of a mindset thing. And I know you wrote about it in your book, but just changing your mindset. And when you you speak to younger people, and by younger people, I mean people in their 20s and their 30s.
Yep.
And they go, really? I didn't know you could do that. So what do I need to do? I just got to save up that much and then do this and other, or maybe they've got parents and you can draw a bit of equity and just to get started.
All the basics
get
that
started.
we think are basic questions, but some people just, they're just, if it's not talked about, it's not uncovered.
And I'll say for tradies as well, the guys and girls on the tools, is that they're often some of the best but the worst property investors, right? Because they're the worst because a lot of the times they just never get started for whatever reason, right?
Yep.
But they're often the best, and particularly in this market, because I think you're going to see a lot more. And back to the person we were chatting about beforehand, we're coming to do a toolbox talk with you first.
Yes.
If that's okay, I think we might need.
He might be on a few fancy sites.
We might need security clearance, but we do it in the car park. It's cool.
Absolutely.
But in the market that we're moving into, I see there's going to be a lot. Yes, the market may not do the heavy lifting for you now in capital growth, but smart cosmetic renos will, or even sort of smaller structural type renos.
Yeah.
And the best people to take that on are tradies. Like most tradies can do a reno.
Yeah.
Like if you're a plumber, typically, you can do plastering and building work and like cosmetic stuff.
You're handy enough.
You're handy enough. You can't do electrical.
Well, Phil, I'll challenge you there though, because as much as you like to say that you're handy, some would argue, and I've been on quite a number of building sites with you, completely unsafe.
Yeah.
Firstly,
I wouldn't say that from an OH&S point of view. Might not necessarily be the best.
Zero insurance coverage.
Yeah.
However, what I'm going towards here is that you and I both have bought plenty of property and got our little sweat equity outcomes from them.
Yeah.
And, there has always been, and there will always be, and there might be more so in the next 5 years, a very, very distinct opportunity for people to say, how do I increase value in my asset? Whether it's perceived value, bank value, or market value, there are ways to do it. And you don't need to have a trade to do it, but it is going to be something which people need to be more aware that, hey, and I've got literally had a client yesterday who I had a meeting with him about, we're transitioning a property out of Perth and into a Melbourne market at the moment. They're selling a property in Perth, and I had a meeting with him. He said, I just came back. I just flew. And this guy is a 25-year white-collar veteran. We bought a couple of properties in Perth from him in 2020, 2021, one of which was large block, average property. Tenant was in place, hadn't touched it. Selling the property now. They moved out. He was, as it turns out, flew there on Thursday, hired a car, went to Bunnings with a laundry list, filled it up in the hire car, slept on the floor in this house for a weekend. This guy's 55, and spent 3 days painting certain different parts of bloody skirting boards and cornices, fixing a couple of hand locks, and essentially got a Jim's mowing crew in to do and supervised a couple of different things around there. Essentially a 3-day reno.
Lined it all up.
But did it himself. Zero experience in any of this stuff, but knew that, hey, look, I could get multiple quotes. It wasn't even a money thing. It was more, this is going to take too much time and effort to get this ready to go. I could probably save myself 25 grand. He said he spent about $2.5 grand. Property looks fantastic.
Yeah.
He's got it dressed on the market, and he's probably going to get about a 40, 50 grand uplift from his 3 days worth of work.
Weekend.
That's reality of good property investing when you want to max it out. Now, you don't have to do that to sell a property. You do that to get a valuation on property. I remember you and I back in the day, we'd go through a weekend, sometimes a week or two, and then get the valuers in. And then you try to shadow the valuers.
Yeah,
we see that.
I remember you sit there with one of those.
What do you think about that chimney?
But you get one of those photo album books.
Charm.
You get one of those photo album books from like Target.
Before.
Yeah, and you go, look, here's the before and here's the after. Look at this here. And they sit there going, yeah,
mate.
whatever.
Can you please leave me alone for the 4th time?
Yeah, they just go, there you go, there's your valuation, leave me alone. You got to hustle for it. But that I think there's more of that. Like, I'm probably not going to do that these days. I'm not going to go and give up a weekend to do it.
But you did at the start.
But I did at the start. But I still know how to do it, and I will just get trades to do it for me now.
Yeah,
and then
there's less margin in it because you're going to outsource it. But I'm telling you, like when you were doing it, you didn't have 3 kids. No. You didn't have all the other things that commitments.
Yeah.
Now, and this is it. Right? Like you're going back to these 20, 30-year-old tradies. If you're going to get started then, and you want to know what's the secret is you got to do a little bit.
Do the work.
Buy the correct asset, absolutely. And our job is to do that for you. And it might mean to say, hey, we can get this. And I'm telling you, you've probably got about 30, 40, 50 grand uplift in this if you want to go and spend a weekend and literally just do the basics. There are plenty of opportunities that are going to arise in that space very, very soon, if not already and immediately.
Yeah. There you go. Toolbox Talks with Glossop. Let's see. Let's just see how people react and respond to that. I think it's a great opportunity.
It's got legs. We're going to have to go to Bunnings and get ourselves one of those little flat grill barbecues.
I've got the car. I've got the right car for us.
Okay.
To rock up in.
We'll rock up in the
my vintage,
the Hilux, the vintage plates.
Yeah, we won't look like we don't belong on site. We got some high vis.
Do we? Yeah. We get some sponsored high vis.
We got sponsored high vis.
Bisley.
Bisley. What's
Bisley,
the inquiry?
shout out.
Yeah. Mate, you can
some Bloodstones.
You can be a door sponsor.
I need some steel caps.
Yeah.
Yeah.
I need new boots. Mine are a bit sort of on the way, but anyway, where we're going with that? That's a shout out. You know who you are. You're probably not fishing anymore. You're probably back putting in wires in some data center somewhere. But we're thinking of you, and don't take more out of the sea than what you need, because I know he loves bagging out. He loves to bag out
for no other reason other than to say I bagged out.
He bagged out, and this guy is he's his species that he likes to target is
the Ludwig
drummer and the drummer. Drummer. I know his spot as well. So if he doesn't write to us and sort of toolbox, I'm going to disclose it. I'm going to disclose where it is.
Exposure.
Yeah.
All right. I like
if you're going to fish it, you'd fly into Ballina, and then you'd drive it in a car from there. There you go. I know where it is. Anyway, so there's all these changes to the
lots
taxation,
of changes, more than we've ever had.
Yeah.
In our careers.
Yeah. So, and I don't need to go over the changes because everyone probably knows what they are.
You'd hope so by now.
And the logic of the changes is to, according to the government, improve affordability and get more younger people into homes, and that's cool. If that's what people want, that's cool.
Yep.
But there is a lot of criticism, and we've been talking about this. And I remember as soon as that happened, was October of last year going this increase to the 5% deposit scheme and moving a lot of the caps around it. It's going to cause a lot of problems, and I think the chickens are coming home to roost. If you're transacting as a first-time buyer now in and out of property, and you have to sell in a market which is downwards, you may find yourself in problems, but hold on as much as you can. I imagine most first-time buyers or homeowners will do whatever they can in order not to go to foreclose on their house and end up in a situation. So, but anyway, lots happening. And you would be led to believe that this is the worst the housing market has ever been. The headlines are auction clearance rates are sort of towards GFC levels, so there's a lot less appetite in the market. That was obviously one of the objectives of the government. Whether or not it's gone too far, who knows? It's a moment in time. So to put this into perspective, and I wrote an opinion piece on this, and I titled it, while everyone is losing their head, keep yours. Pretty much going, everyone just relax. It's a moment in time. It's all going to be okay. It's cool. Does the data tell us that historically that it will be cool? Because I would imagine as someone whose job is to help people find houses, you would say that property is still a great asset class and you should continue to buy it as an investment.
Of course.
Yes.
But for me, probably the more substantiated response is, well, why?
Yeah.
And have we been here before? Yes. Have we seen this same market outcome and market movements? Yes. What happens in these markets? Well, there's data to tell us what happens in 5-year blocks pretty comfortably. I wrote a book about it.
Did you? What's it called?
If anyone wants to see, it's right there, Surfer's Guide to Property Investment. And we are right now
The
flipping
next wave.
The next wave. Well, this is the second installment. We're on page 80, where we break down 80 and 81, where we break down 5-year segments between 88, 92, 93, 97, 98, 2002, 2003, 2007, and we flip the page and we've got more between 2008, 2012, 2013, 2017, 2018, 2023. Data finished about 2024, which coincides with about the last period of cycle growth. But
They just sound like a jumble of numbers then.
they were all 5-year blocks of
Okay,
time.
there we go.
And I'm going to tell you what happens in those
You
times.
tell us.
But let's
Tell
go
us.
back. Let's go back before we talk about what happened in those times
Yeah.
from a growth from each of our major cities. There were different taxation periods that applied, believe it or not.
And different governments.
And different governments. So if everyone wants to go back to a trip down memory lane, in September 85,
Yeah.
the Hawke-Keating government at the time introduced the CGT indexation method, which we've reverted back to as of now.
So there's no CG tax before.
Prior to 85, there was no capital gains tax.
Ooh,
Happy days.
imagine that.
Imagine that.
Imagine if your parents were smart back. Imagine if your parents were doing what we were doing now.
Well,
back then.
ironically, property
There
didn't perform
was.
better back then either. It
Well, this
performed
is-
about
this
the
is the
same.
story,
But
yeah.
but again, going back to then, so we had this exact law
Yeah.
passed in 1985.
Yeah.
So it essentially said that any capital gains tax from here thereafter, it was indefinite at the time, was going to apply this indexation method. Now, effectively, within reason, this is effectively the same policy now. Now, the intention there was that people weren't going to be speculating to buy, in their words, speculating to buy houses to make a profit and sell and not pay any tax because they wanted to get a lick of that ice cream. Now, you would assume that, okay, well, if they put all these brakes on, was that to increase the first home buyer participation in buying property at the time, or was this just to get tax receipts? Did we have a housing shortage and a housing problem in 1985, Phil?
Probably.
Well, I mean, if you look at the data, the properties prices still grew at the same rate. So and the data's not completely aligned to that, but let's just go back to when that was in place, 1985 to 1999, until we essentially saw then that the Howard Costello government put in place the 50%
Yeah, that's
CGT.
too hard to work out the indexations, a nightmare. Let's just simplify it.
That was more or less the methodology. It wasn't that we need to tax people less. It was just this is actually working out to be an accounting nightmare.
Yeah.
Let's simplify it because it works out to be about 50%.
And
That's
the
why
balance of things, it's probably thereabouts.
and that's what
You
we're
win
back
some, you
at.
lose
It's
some.
going to be about the same for the next 15 to 20 years if you apply the last 30 years worth of inflation. So assume that the CGT is actually not going to really be any different. But if you look at what the differences are, they're saying that we need to change CGT to make it fairer. Well, I don't believe that's the case.
Yeah.
I believe that it's potentially a headline, but it's not going to make things cheaper or more expensive because between 88 and 92, if you aggregate every market, Australia grew by 58.8% in that 5-year block when this indexation method applied. If you compare that to, let's go to 2003 to 2007, 53%. The market grew in that 5 years after the 50% CGT discount applied. And I can pluck out the next 5 years between 2008 and 2012. The market grew by 12.2% in that 5 years, Phil.
It's a bit slower.
Bit slower. And then 48% and then 46%. Ultimately, each 5-year block is not dictated to by the tax laws. It's dictated to by the supply, the demand, the price of money, how many properties are being built, how many people are migrating to this country, all the things that are in between that we talk to ad nauseum on this podcast.
Yeah.
What people need to understand is that these changes are not going to affect the market dynamics in isolation.
Yes, but you may. So the highest growth, just listen to you, the highest growth of the 5-year block was what, about 50-something%?
55%.
And what was the lowest growth over? There's 12 point something, I think you said.
12.2% after the 50% CGT was announced, but also between 93 and 97, this is prior to the 50% CGT changes, it grew by 14.8%.
And that's when you had really high interest rates.
We had high
around
interest
that
rates correlated to high interest rates. And again, we're in that.
time. So So what the government is trying to do is to make property not grow as fast as what it has done in the past.
Well, that's their
maybe
tagline.
that's the benchmark they want. Maybe they're going, well, should maybe grow by 12% in 5 years rather than 50% in 5 years. Maybe you got to remember Dr. Jim Chalmers, his doctorate was on Paul Keating.
The nepotism.
So he's done a doctorate on Paul Keating. Oh, no, that's what Paul Keating
The previous
do.
treasurer.
Yeah. I'll just do what he's done, which is what they've done. They've borrowed a lot of his stuff, right? Like, that's his.
But it's the Labor playbook.
Yeah.
So
they just, if they're going, but that's what they should do. They go, we want property to grow in a 5 year period by about 12 or 13%. Look at him, he can't help himself. Rather than 50-something%. Like, I don't know. Would you be happy about that?
Well, I mean,
12% growth. Like,
it's neither here nor there, Phil. Because would I be happy? Well,
does it really matter?
It doesn't really matter.
Let's talk about what really matters is yield and cash flow.
Well, then it becomes.
I'd like to see how that correlates around it, because we're already seeing is that the cycle of narrative from your property commentators, whether or not we're part of that, I don't know, is less capital growth. Now everyone's talking about yield, and everyone's already talking about renos. And I said this ages ago. Like, that's what's going to happen. Yeah, fine.
Pretty obvious.
Move into that market. That's fine. And you've got to have to work a bit harder for capital growth. But the yield situation, unless we get this a huge amount of stock coming on the market because your super funds start building,
which ain't going to happen.
200 block towers.
But they can build 200 block towers. They're not building 200 houses in.
Well, we're short. We're so short.
This is it.
But I reckon you're going to start seeing a lot more incentives going towards that. Institutional sort of developments, and maybe that will.
And that
help.
will. And if it does, it will take time. Yeah. So it'll be flagged early. Real early.
Yeah. So what do you do then?
Well, I mean, going back to your point though, Phil, is that if you see these blocks, and these blocks show that basically you get these large blocks of growth coupled with relatively blocks of sideways movement or in line with inflation, and then growth again, then in line with inflation again, so on and so forth. If the next 5 year block ends up being, and again, I'll recite a couple of points here because
here we go. More. What's the name of the book again?
Surface Guide to Property Investment, The Next Wave. Get it on my website, purepropertyinvestment.com. But again, I'll go to these blocks because this is why I talk about these blocks, but I also don't talk about each major market. But in that 88 to 92 block, Brisbane grew by 100%.
Yeah.
Adelaide grew by 25%. The market grew by 55%. So I'm talking about the market. You can't buy the market. You can buy a property in one of those markets, which isn't going to move at the average. If I go to the block where 93 and 97, the market averaged 14%, Darwin grew by 56%, Canberra went backwards by 5% in that 5 years. So my point here is that if you want to get the average, your property is not going to get the average.
No.
There are still always going to be markets which will get well above the average in each of these average and excellent 5 year blocks. So don't just think, well, if the market's going to do an average number, I'm not going to bother, or I am going to bother. There is always going to be better and not good markets. I mean, the following 5 years, Melbourne 88%, Darwin did 5%. In the next 5 years, Perth 140%, Sydney 16%. The narrative keeps going. So don't get too carried away that the market is going to do this.
So
it's
numbers,
what you own.
Numbers are largely irrelevant. They're a bit of a sort of, okay, that's nice to orientate yourself around them, but there's I don't know how many different 10,000 suburbs or something in Australia.
More 11,500. So I guess going back to this though is that if we go back to the data and say, well, what is the next 5 year block hold? Well, I would say strongly believe that there is going to be stronger rents. Absolutely, it's for me, it's a no brainer, and that's not going to be selective to particular markets. I think that's going to be a pretty ubiquitous uplift. There's going to be less supply. I have no doubt there'll be less supply in the next 5 years because you've got less people who are going to be incentivized to want to buy a new home to live in, certainly less people to buy brand new investments. Yeah. And you've taken now out SMSF investors for resi as well.
What's cut out? I think the issue is and this all comes back to a finance thing, is that there's going to be less capacity for people to invest in property.
Yep. Because
their serviceability won't stack up because negative gearing has been taken away. And that's one of the reasons why the government has chosen to do what they've done. So there's going to be less investors in the market, or there's going to be the same amount of investors, but they're only going to be owning a lower price point, more competition, but maybe one property. Like I think you're going to have more investors with smaller portfolios.
I think for the time being that will be very likely, and that's fine.
Yeah.
I mean, we're not here to advocate, and we've never been here to advocate. But people should buy 10 properties and then move on. I mean, if you can collect them and balance your cash flows and provide good housing to the market that needs it, you will do well. But to get the money is hard.
But the core point then is that if most investors, there's already most.
It already is. It's already,
but more
90% own one or two.
Yeah. So what that means, and one or two probably was, it depends. One my personal, maybe one in super or something.
Yeah.
But that's normally in personal names. The property that you buy is going to become even more important because you're probably not going to be able to buy more and more by recycling equity and all that sort of stuff because serviceability just won't allow it. So the property you purchase is now even more, it's a lot less forgiving in this market.
And I think people also need to have a mindset to say, I need to be more patient.
Yeah.
Because buying a property and thinking I can then take a 2 or 3 year growth position and recycle 20% of growth into an equity release and then buy the next property becomes less likely.
Yeah.
So it doesn't change the mantra of buying quality property and holding it, but it probably changes the mantra of thinking, hey, what happened in Perth or Brisbane or even Adelaide in the last 4 or 5 years is going to keep repeating. It may well in isolated markets, but you're not going to be able to leverage off it and piggyback and keep that property and then go again. It's going to be more of you have to trade that property if you want to take that profit and crystallize it, which is fine as well, to be honest with you, because it creates a cycle of supply. And I don't think the government will hate that because there's tax receipts collected on both ends when people do that.
Yeah.
So I have no issues with that if you do need to do it and chase the next market, but you need to be pragmatic in the thoughts that, am I going to buy for a 4 or 5 year growth cycle and then sell? If that happens, well done, congratulations, but don't plan on it. Plan on a 10, 15-year hold because the data will tell you that there's going to be good 5-year blocks and there's going to be average 5-year blocks pretty much every 10 years.
Yeah.
So buy with that in mind and be patient.
It's good counsel. And back to our tradie friends, there's a mission to support Australia's tradies. I was just sort of visualising maybe like one Friday or a Friday a month where you just load up the van and you start at 7 o'clock somewhere and you just get the sausage sizzle running constantly in the back of the car and you just drive from site to site.
Maybe we'll get sponsored by a pub. Maybe that's a better pace. So rather than being on site, maybe we can then get a few different. We'll start at sites.
Yeah, start at sites.
If we get too much traction, we might have to go to the
we could do.
the local rubbity. So the local pub somewhere nearby.
Yeah.
We've got plenty of good boozers in Sydney who a tradie likes to go and share the worries on a Friday arvo and have 1 or 2 frothies before they go home to their kids.
A bit like just this vision of like the new sort of Black Thunder where you arrive, you rock up.
Just in the car park.
In the car park.
On a soapbox.
Yeah.
And just shouting it out.
Talking about property.
With your air gun shooting T-shirts.
Toolbox talks. I can see it. It'd be brilliant. But we'll just go door to door.
Start small.
Yeah,
Let's start small. Let's not get carried away.
But, if anyone...
I'm happy to have plenty of special guests as well.
We can get so many special guests.
Some great special
guests. I can get
guests.
Polly's, we can get everyone, mate. It'd be real organic because it's Australia. And no doubt if anyone out there who runs a Toyota franchise, I'm sure we could certainly use with the new Hilux to get around.
We could definitely sponsor that Hilux. That Hilux could be absolutely, they could do the tour around town.
Yeah.
Every town.
Yeah.
Any town.
Bunnings.
Makita.
Anyway.
All these sponsors.
Kubota.
They're all very welcome. Kubota's a good one.
I like Kubota.
Okay. Yeah. You're running yourself a little folly farm there, so no doubt you could get anything that you'd be happy with.
Yeah, good news, sort of like good 8-tonner excavator would be nice.
Okay.
Yeah, that's what I mean.
It's completely out of my need or necessity.
Yeah, but anyway, I could see it. Mate, if this is what the punters want, I reckon, mate, you did that. Servicing. This is what tradies need. And then you can sort of expand it out. Then you can do nurses. And you can do the cops. I know the cops love us.
Do it in the ER.
There's a lot of cops. Yeah.
Do it at
out of the way.
Out of the way. We just do it at the local. Do it at the hospos. Do it at all the anywhere where people are just doing work.
This is Australia. This is Australia that's getting forgotten about, Paul.
Well, they're
people with real
They're the
jobs.
ones who actually are buying investment properties. Believe it or not, they are the 90% of the cohort who makes up the property investment population.
They are.
They are the people who are like, I need to better my retirement position.
Yes.
And this is how I'm going to do it.
Yes. And this all originates from you, Mr. Fisherman. you're behind this. He'll be our special guest. He'd be a great special guest.
Maybe he needs to be like the Stig. He can't ever be unveiled.
Everyone's going to be go, who is this guy? I'll tell you, it's
you won't understand what
he doesn't say a lot. Everything that's right about tradies in Australia, that guy. He's the Stig. What would you call him?
The pig, the property investment
guru.
The pig. That works on so many levels.
Oh God, it's a term of endearment, by the way.
Absolutely. It's also a term of the drummer. People refer to the drummer as the pig. As the pig.
Yeah, that's right. There you go. Yeah. I won't use the nickname for Ludwig. I think that'd be a bit offensive.
No, a little bit offensive. Yeah.
No, but anyway, I want this to happen. So please, someone out there running a building site, you can be the first.
All right.
It's going to be whatever the local butcher is. Obviously, going to be sponsoring this. Baker's Delight. You can get a door sponsor on the new Hilux, mate. This is what's going to keep Australia moving.
We're going to bring it.
Bring it. All right. How do people get in touch again?
for the Toolbox Talks?
Well, everything. Anything. Just
they can do it the same way. purepropertyinvestment.com. They can give us a call. Anyone who wants to do a Toolbox Talk.
Yeah.
1300 9854
Toolbox Talk. Say it's Toolbox Talk. What is it again?
Toolbox Talk 1300 985428 or inquiry at purepropertyinvestment.com. Put in the subject matter Toolbox Talk.
Yeah.
Wanted, required, necessitated.
I've already got a sponsor for us.
Okay. You?
No, but I know someone that will sponsor us.
Okay, good.
Yes.
Can we announce it?
Yes.
Okay.
It's a mortgage broker.
Oh, good. Oh, see, there's some very good ones. Insurance brokers.
Finny Mortgages.
Finny
Mortgages will be the inaugural sponsor of the Toolbox Talks.
They can sponsor the bangers.
Yep.
If we don't get a butcher, that is.
No, I'll have to speak to them, but
here we go. He's already backtracking.
No, I have a good account. So I reckon we can probably hit Finny Mortgages up.
Okay.
For the capital, which will be the barbecue.
Yep.
And the bangers.
And it's going to go on the back of your ute.
Yep.
Pre-prepared, ready to go.
All right. For Toolbox Talks.
Toolbox Talks.
We'll go around the nation, teaching people.
Just spreading the good word.
Spreading the good word. How to do it right. Not all property investments right, by the way.
Okay. I like it.
But I'm sure they will be happy to sponsor us. Phone number again?
1300 985428. And for anyone genuinely,
why use inquiry? Like, is it E or I? Like, people, do they both work?
Yeah, they both work.
Okay. Yeah. Inquiry.
But do it with an E. Do it with an E.
Enquiry.
Yes. Inquiry.
Yes. At purepropertyinvestment.com. Does .com.au also
just
work?
.com.
I know. Does that .au still work?
It does, but you don't need to.
I know.
It's more letters.
I know.
Philip.
I know, but people.
Why do you want to do more? You're confusing everyone.
I'm just trying to make sure.
Stop it.
Just trying to make sure. Toolbox Talks, do it. Thanks. Good to see you. That was. I want this to happen. I can see it. I'd love to spend my Fridays doing this.
All right. You and me both.
Yes. Thanks for tuning in for the podcast, the Pure Property Investment Show. What's it called again?
Pure Property Investment Podcast.
Podcast.
Yes.
With Paul Glossop.
Well, it could be with Paul Glossop. It could be with Phil Tarrant. It could be with
it's
anyone.
Not with me.
Well, it could be with anyone.
No, and tell us who
with the pig.
Yeah, with the pig.
The Pure Property Podcast with the pig.
With the pig. We'll get him on one day.
I reckon he might be a guest, and we're gonna mask him up.
Yeah, we will do.
All right.
What's the equivalent of a helmet for a tradie? It'd be like a KFC bucket.
Jeez, you're stereotyping. Those traders out there, just you call yourself they're probably the fittest cohort of people out there.
They do like KFC though.
Well, depends.
Mate, the traders on when I'm around the site.
Most of them on the pre-packaged bloody muscle meals these days.
Yeah, they are these days. There we go. There's another sponsor.
Oh, see, there you go.
I can see them.
High protein, low carbs.
We can give you a bonnet sponsor, Muscle Chef.
Some good coffee vans. A good local coffee van, spitting out just good short blacks.
I want this to get so big that we need cops to actually start brocking down roads.
Yep. Yeah, okay.
You know?
Just got people, got the chicks chasing the van down the road. They go, stop, can you sign my shirt?
That's enough. Thanks for tuning in. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.